Welcome to the deep dive. Today we're cutting straight through the noise of the Q3 2025 earnings call for QuantumScape, ticker QS. Definitely one to watch. The market reaction was pretty positive. Seemed like a real shift in how people are viewing the risk here.
Absolutely. It suggests, that management laid out some concrete points that really boosted confidence.
So our mission here is to figure out exactly what those points were. What operational bits, what financial discipline allowed them to pivot the story away from just pure R&D.
Yeah, moving towards something that looks more like commercial viability. It's all about execution confidence in this space, especially with solid-state batteries being so capital-intensive.
Okay, let's start at the top then. The headline numbers. What were the basic results that set that positive tone?
Well, financially, it showed continued cost control, which is, table stakes for a pre-revenue company. GAAP EPS came in at negative $0.18.
Which beat consensus, right?
Yeah.
I think it was negative $0.20.
That's right. Beat by 2 cents. Sounds small, but like you said, for a company this stage, it shows they're keeping a really tight grip on R&D spend. Adjusted EBITDA loss, $61.4 million, pretty much dead in line with what everyone expected.
And revenue as expected.
Zero GAAP revenue. Yeah. Still pre-commercial. But, and this is the key thing, they introduced a new metric that really caught attention.
Yes. Tell us about that.
Customer billings. They reported $12.8 million for Q3. Now, this is a huge milestone operationally. It's the first real sign of commercial traction, actual invoices going out for their expertise and collaborations.
Okay, $12.8 million. That's not trivial. It's actual cash flow shows customers are pulling. So let's dig into the financial discipline side because that billing number needs time to scale. What about capex and cash burn?
Yeah, discipline looked quite impressive this quarter. They actually tightened their full year 2025 adjusted EBITDA loss guidance, improved it slightly to negative $245 to $260 million.
So they're finding efficiencies.
Seems like it. And they also trimmed the full year capex guidance down to just $30 to $40 million. Q3 itself was only $9.6 million in capex.
30 to 40 million for the year. I mean, compare that to the billions others are spending on gigafactories. That number alone really underlines that whole capital light idea, doesn't it? It really does. And, those controls directly led to the biggest financial news, the Runway extension. They finished the quarter with $1 billion in liquidity. Nice and robust. $1 billion.
Oh, and based on that lower burn rate, that tight spending, they now project their cash runway extends through the end of the decade, specifically December 31st, 2029.
Wow. End of the decade. That's a full year longer than they said last quarter, right?
Exactly. A 12-month extension, significant breathing room.
Okay, that extension is huge. Buys them years.
Mm-hmm.
But here's the question. Management also said they plan to stop giving regular updates on the runway metric and focus only on billings. Doesn't that feel a bit like pulling back transparency on their survival clock?
Yeah, look, that's a fair question. It definitely raises an eyebrow initially. But management is framing it as confidence, not concealment. They're essentially saying, look, we've handled the survival question for the next 5+ years. Now judge us on commercial progress, judge us on billings.
So it's a strategic pivot, maturing the story.
Exactly. It's necessary.
Yeah.
That runway isn't just survival. It's what gives them the freedom to execute on these really complex, long lead time operational goals without constantly worrying about the next capital raise.
Financial stability buys execution freedom.
I like that. Okay, let's pivot to that execution then. What tangible progress, what tech validation did they actually deliver in Q3 to show they're using that runway well?
Operationally, Q3 was pretty successful. Big one was starting shipments of their Cobra-based QSE-5 cells. That checks off a key goal for 2025.
Okay, remind us quickly, Cobra is the manufacturing process, QSE-5 is the cell itself? Correct. Cobra is their proprietary method for making that unique ceramic separator efficiently. And QSE-5 is the next-gen cell format, designed for better performance, more towards automotive needs. And these specific cells went into the Ducati V21L program, which leads us to probably the most visible event of the quarter, that public demo at IAA Mobility in Munich.
Right, the electric Ducati race bike. Very high profile, really highlighted the VW Group collaboration, Audi PowerCo, all involved, showed the tech can actually be put in something demanding.
Precisely. The Ducati program is like a high-stress test bed, low volume but high visibility. Test the tech in extreme conditions. The next step now, and it's crucial, is field testing, getting real-world performance data back from that program.
Okay, field testing. And what about scaling up manufacturing? Any news there?
Yeah, they confirmed the installation of their higher volume equipment on the pilot line. They call it the Eagle line. It's in San Jose. That's still fully on track. The Eagle line is really the bridge from R&D success to making cells repeatably and at higher throughput for commercial use. Got it. Eagle line on track. Let's shift now to the bigger strategic picture. This whole capital light licensing model. What does that actually mean day to day? How's it different?
It means focusing on the IP, basically. Prioritizing their specialized knowledge, the ceramic separator, the Cobra process over building massive factories themselves. They see that IP as their core asset.
So they avoid the huge fixed costs of gigafactories.
Yes, exactly. They want to leverage the manufacturing muscle, the balance sheets, of established partners instead. It de-risks their path to scale up, keeps capex way down.
And we saw that strategy get some serious validation this quarter with two big partnership announcements in ceramics, right?
Yes, absolutely fundamental announcements. First, a new joint development agreement with Corning. They're going to co-develop the manufacturing for the Cobra-based ceramic separator. Corning obviously has deep expertise in high-volume glass and ceramic sheet production.
Okay, Corning for the base material. And the other? The other was Murata Manufacturing. They finished an initial collaboration phase successfully and signed a new contract to ramp things up, including volume commitments. Murata's expertise is more in things like stacking, coating precision steps after the ceramic sheet is made.
Ah, so they're complementary. Corning makes the sheet, Murata processes it further. Makes sense why you'd need both for different parts of the puzzle.
Precisely. Management basically said the market opportunity is just so huge. They need both of these world-class players. They cover different but equally essential parts of making that separator work at scale.
Okay, so if the model is capital light licensing, how does the money actually flow back to QS long term? Beyond the immediate billings, what did management outline?
They laid out three main streams. First, near term, is that collaboration and customization work, which shows up in the customer billings metric we talked about.
Right, the $12.8 million this quarter.
Second, and this is expected to be the biggest slice of the pie eventually, with the highest margins, is licensing royalties. That's partners paying to use QS tech in the cells they produce.
Okay, royalties, the long game.
And third is value sharing from ecosystem partners like Corning and Murata, maybe through JVs, maybe sharing cost savings, that kind of thing.
Got it. Let's circle back to those customer billings for a second, specifically that tricky VW accounting detail. You have $12.8 million in cash coming in, but it doesn't hit the income statement as revenue. Why is it treated so strangely?
Yeah, it's a bit confusing, but important. It comes down to the related party relationship with VW, specifically PowerCo. Because of that close tie, when VW pays QS for collaboration work, U.S. GAAP rules require QS to book a liability of the exact same amount on their balance sheet at the same time the cash comes in.
So cash goes up by $12.8 million, liability goes up by $12.8 million. Sounds like it cancels out. It sounds like it, but here's the crucial bit. QS has no obligation to repay that liability. It's not debt. Think of it like deferred recognition.
As QS meets the collaboration milestones, as they satisfy their obligations to VW, that liability gets relieved, it comes off the books. But instead of flowing through the P&L statement as profit then, it bypasses it entirely and adds directly to shareholder equity on the balance sheet.
Ah, okay. So the cash benefit is real now. It boosts their liquidity today. But the accounting profit recognition gets deferred and eventually just strengthens the balance sheet value directly rather than showing up as income right away.
You got it. It's an accounting treatment specific to this phase of the VW deal. But the financial benefit, the cash in the bank, is real and immediate for shareholders.
That clarifies things. And it really highlights why billings is the metric they want us watching. Now it shows the cash is flowing, the partnership is active, even if the GAAP revenue isn't there yet. Okay, looking forward then, what's the roadmap? What catalysts should we be watching for?
Well, commercially, they are clearly branching out beyond just VW. They confirmed they're actively engaged with a new top 10 global auto OEM. That's on top of VW PowerCo and another existing unnamed customer. Getting that third-party validation is key to reducing reliance on just VW.
A new top 10 OEM, that's significant. What about the VW timeline itself? Did they give any updates there?
They did. They explicitly clarified VW's goal remains a serious production car with QS tech before the end of the decade. So confirming that December 31st, 2029 target, and management added that they're actively adapting their own roadmap now to sync up with customer timelines, try and hit that goal as fast as possible.
Okay, so the 2029 deadline is firm and the pressure's on to align execution. What are the near-term execution things to watch then?
We definitely need to watch the manufacturing ecosystem. Key catalysts would be a Updates on throughput from the Eagle Line pilot facility. Performance data coming back from the QSE-5 cells in that Ducati field testing that's huge.
Real-world data.
Exactly. And hitting milestones with Corning and Murata. How fast can those partners ramp up yield on the ceramic separator? That's probably the biggest factor determining if they meet that 2029 timeline.
Makes sense. Okay, let's move to our segment that is very explicitly not financial advice. We've just spent time confirming QS is executing this pivot to capital light, IP first, banking on specialization. If you were pitching a trade idea based purely on this narrative, what's the thesis? The thesis is simple. This quarter validates specialized disruption. QS isn't just changing the battery cell, they're changing the supply chain for components feeding into batteries. We reward them for de-risking the scale-up nightmare and betting everything on their unique ceramic IP.
Okay, so give us the outrageous but plausible trade.
All right, it's a classic long-short pairs trade, playing the component specialization shift. You go long QuantumScape, you're rewarding the billion-dollar buffer, the long runway, the Corning Murata validation. You're betting that ceramic IP converts into those high-margin licensing royalties long-term, which management basically said is the main prize.
Long QS and the short. Simultaneously, you short a smaller, traditional lithium-ion separator maker. The logic. QS's specialized ceramic separator, validated by world-class partners, makes the old polymer liquid separators look like they're heading for obsolescence, maybe faster than the market thinks.
Because the old guard can't easily pivot to ceramics.
Exactly. They likely lack the IP, the deep ceramic processing expertise. QS's capital-light success signals that these legacy component suppliers are vulnerable. It's a bet that their specific niche is facing an existential threat.
A pure component pivot trade. Long the specialized disruptor, short the potentially obsolete incumbent. Interesting. Okay, let's wrap this deep dive up. 3 critical takeaways for the listener.
Financial discipline is strong. They tightened guidance, extended the cash runway a full year, giving them operational security through 2029.
Got it. Runway secured. 2.
Real operational progress. Shipping Cobra-based QSE-5 cells, the high-profile Ducati demo, these aren't just lab results anymore.
Okay. Progress validated. And 3.
That $12.8 million in customer billings. It signals the start of actual monetization for their capital-light ecosystem model, backed by serious partners like Corning and Murata. The model is starting to generate cash. All right, so the Q3 call really pushed this idea that QS is selling specialized recipes, their IP, their process, rather than building specialized kitchens, the gigafactories. Here's the provocative thought for you to chew on. How fast can their partners, the ones who own the kitchens, actually master cooking with that new recipe? How fast can they compress the yield learning curve for solid state? And what does that speed mean for hitting that VW timeline of before the end of the decade?
Thanks for tuning into this analysis. We look forward to exploring more with you soon.